Welcome to the Mining and Metallurgical Society of America webinar series. MMSA is an association of mineral resource professionals whose members represent all facets of mining and metallurgical interests, both domestic and internationally. MMSA has always been a cohesive group of senior people from the mineral industry. The society is dedicated to increasing public awareness and understanding about mining and why mine minerals are essential to modern society and human well-being. The society concerns itself with fundamental principles and with problems facing the industry in such areas as legislation, economics, and education, as well as environmental concerns, labor relations, and health and safety. Representatives of the society from time to time testify before legislative bodies and provide advice to federal agencies. I'm Betty Gibbs. I'm a past MMSA Executive Director, and I'll be introducing the webinar. This webinar is the second in a series about battery metals, and also as a follow-up to Chris's presentation on January 15th, 2021. That presentation was called The Size of the Prize, Building a Domestic Battery Metals Supply Chain. And that webinar is on the MMSA website. The title of today's webinar is The End of the Beginning, an update on global competition for dominance of battery metals supply chains. During the webinar, you can enter any questions in the chat, and we'll answer the questions after the presentation is completed. Curtis Clark will now introduce the speaker. He's chair of our QP Enhancement Committee, who is the webinar sponsor.
And good afternoon, everyone. We're very pleased to be able to have a return engagement from Mr. Chris Berry. Chris is based in Washington, D.C., where he has been an independent analyst for the past 14 years, focusing on battery metal supply chains, including lithium, cobalt, graphite, nickel, copper, vanadium, and the rare earths. His work supports a roster of global clients, including investors, mining companies, oil and gas companies, and electric vehicle OEM manufacturers across 6 continents. His advisory work has a specific focus on how battery metal supply chains are evolving to create opportunities and threats during the energy transition in the coming decades. Aside from traditional supply, demand, and pricing analysis, his recent work is focused on battery recycling, alternative extraction technologies, and how battery metals will play an increasingly strategic role in geopolitical and supply chain realignment. Before shifting focus to analysis of these trends, Chris gained 12 years of capital markets experience on both the buy side and the sell side. He has visited and performed economic analyses of metals deposits on 6 continents and has been featured by multiple media outlets, including the Financial Times, the Wall Street Journal, Bloomberg, NPR, the South China Morning Post, Al Jazeera, and CNN International. Chris holds a Master of Business Administration in Finance with an international focus from Fordham University and a Bachelor of Arts in International Studies from the Virginia Military Institute. Chris, we're all ears and eyes.
Thank you very much for that kind and probably way too elaborate introduction. And thank you, Curtis and John and Betty, for the opportunity to come back as a repeat, I guess, offender. Very pleased to be back and share some ideas and kind of an update to the original presentation that I was pleased to deliver back in, I guess that was January of 2021, which in many ways was a much different economic environment and also environment for the battery metals. And that's one of the things that I guess I'd like to do today for all of you who have taken the time out of your day and your Friday afternoon to hopefully learn a little bit about what's changed and in some cases what has stayed the same. As was mentioned, more than happy to take any and all questions. I think we're going to try to keep them to the end just for the sake of consistency. But this presentation, I think, will be made available and so will my contact information as well. Okay, and so with that, we will go ahead and get going on what is the Ides of March, March 15th. So again, don't want to belabor that very kind introduction, but as was mentioned, based in Washington, D.C., have been down here since for about 4 years now, actually, kind of understanding how Washington works, which has been a very interesting and enlightening experience to kind of complement my capital markets experience. But just had a lot of opportunity to visit mineral and metal deposits, and as was mentioned, recycling projects all over the world. And you can see here I am a few years ago, gasping for breath at about 4,000 meters of elevation, maybe not quite that much, maybe 3,000 meters in Argentina. So a lot of fun for sure. Okay, so as you probably, for the history buffs on the call today, you probably recognized this idea of the end of the beginning coming from none other than, or the phrase the end of the beginning, I should say, coming from none other than Winston Churchill. I think the idea that we are not really at the beginning of the energy transition, nowhere close to the end, but perhaps at the end of the beginning is the right way to think about how things are unfolding, number one, with respect to the battery metals, and how things are likely to unfold going forward. So I just thought the Winston Churchill reference was apt and something to really center this presentation around. From an agenda perspective, I want to just take the next maybe 20 to 25 minutes and talk about 3 or 4 major changes or major shifts that we have seen since my last presentation in early 2021. The overarching question I think I'd like to just help answer or help elucidate today is, where are we in the current cycle? We've seen insane amounts of battery metal pricing volatility. That's one thing I'd like to address. Interest rates across the economy, not just here in the United States, but globally have ticked up. So what does that mean for the challenges and opportunities for financing battery metals projects? Geopolitical risks, again, I think that is nothing new, but arguably has been exacerbated in recent years. So we'll talk a little bit about how to think about geopolitical risk and how you apply that additional risk when you're looking at different projects. And then, again, finally, the probably the biggest difference between my original presentation in 2021 and the presentation today is that the Inflation Reduction Act has effectively really redefined, I think, battery economics and arguably battery metals economics to the benefit of North America and perhaps to the detriment maybe of China and certainly of the European Union. And I can talk a little bit about where I'd like to talk a little bit about some of the specifics of the Inflation Reduction Act, what I think you really want to focus on as the legislation continues to sort of make itself felt, because I think 2024 is the first year where you're going to start to see some of the benefits or some of the results of the investment and the production tax credits that are embedded in the legislation. So anyways, I think I probably had this same chart in my original presentation in 2021. What you're looking at is what I call 5 of the big 6: copper, cobalt, lithium, nickel, and graphite. This is effectively a battery grade or a high grade price for each of these metals. And price performance is the name of the game. And what I'm really trying to illustrate here is the incredible amount of price volatility that we have experienced in this space, literally since the last presentation I gave in early 2021. I have this graph sort of stretched out, of this price chart stretched out to early 2018, because that was the peak, in my view, of the last battery metals cycle. So you can kind of see how things bumped along. We had a change in administration here in the United States. The Inflation Reduction Act was announced and passed. And since then, you can see lithium and nickel in particular have gone absolutely crazy from a price perspective, okay? And I would say one of the major takeaways from today's presentation that you would want to keep in mind is, at least it's my view, that price volatility for these materials is a feature of the energy transition and not a bug. In other words, the lithium price volatility, where in late 2020, early 2021, as an example, battery grade lithium carbonate was trading for about $6,500 US per ton. Over the next year and a half, it exploded to about $85,000 a ton. and then collapsed, and you can see it's sort of trying to find its way forward. And so my argument to you is that with some other issues like higher interest rates, things like that, we'll take a look at challenges in getting permitting. The price volatility is going to be with us for quite a while as we start to build out some of these supply chains. And so there are challenges and opportunities in that, and we'll talk about some of those. I think, one of the interesting things, speaking of interest rates and the cost of capital or the cost of money, in my view, if there's one individual globally who is responsible or going to be responsible for a successful or perhaps a delayed energy transition, today that individual is Chairman Jerome Powell, Chairman of the Federal Reserve here in the United States. What you're looking at here is a chart from Bloomberg of the Fed funds rate. That is the interest rate that banks charged each other to lend between each other overnight. We have never seen such a rapid increase in interest rates in such a short period of time in decades, 3 or 4 decades. And so that sort of has sent shivers, not just through the battery metals sector, not just through the US economy, but the global economy as well. And again, we'll take a look at some data and talk about some anecdotal evidence about what that is doing to the battery metals thesis going forward. It's just making it much, much tougher, I think, to get projects built because, again, as you can see in this chart, this interest rate, if you equate it to the cost of money or the cost of borrowing, was at zero for a long time. Certainly through COVID in 2021, things have materially changed. And so it's forced everybody, whether or not you are a lithium project developer, an investor, an automotive manufacturer, the macroeconomic backdrop has rapidly changed, and I would argue that Chairman Powell has really been responsible for that. Not necessarily a bad thing. I mean, it is what it is, but this is one of the major factors that has really, I think, redefined how to build and how to think about building supply chains here in the United States. And so another way to sort of think about or visualize how much more expensive it's become to build projects is taking a look at the US 10-year government bond. Okay, again, going back to most of 2020 and then peaking into 2021, you can see interest rates are still very low on a historic basis. And the reason why the US 10-year government bond is important as a sort of proxy for inflation is because the US 10-year government bond really does serve as a global benchmark for the cost of capital or the cost of risk. And so you can see, quite frankly, it's just a lot more expensive and a lot more challenging to raise capital based on the fact that inflation has ticked up here in the US and globally, and so have interest rates, I should say, going forward. And so whether or not this stays at this current level or collapses, I personally don't think you're going to see a collapse in this yield, which means that interest rates are probably going to stay higher for a little bit longer. Again, that has implications for you as an investor or a project developer, depending upon where you sit on the supply chain. And so, again, the backdrop I'm suggesting to you today is higher volatility in metals prices or perhaps sustained volatility in metals prices. And so what does that mean, again, coupled with higher interest rates for the true cost of capital for projects? Okay, for you engineers on the call, I'm assuming there are a number of you, I would ask you when you're doing a feasibility study, given everything, given the higher interest rates, given just the very strong demand for these metals, and again, given higher or volatility for pricing is an 8% discount rate, which is typically used for early stage mining projects. Is that sufficient? Again, it's an open question. I'm not going to answer it today. I would argue it's probably a little bit low. I mean, people were using the same 8% discount rate when interest rates were much lower. So it's just something to think about, right, in terms of how to make these projects work and make them economic. And so the blood in the streets, if you will, across the lithium-ion battery supply chain is pretty substantial and pretty widespread, whether or not it's lithium mining companies in Western Australia like Liontown or Allkem, they have projects in Argentina, or battery recyclers like Li-Cycle. Everybody along the supply chain has felt the pinch, again, of higher rates and lower prices in particular for the metals. And so, again, just a huge challenge, I think, and one of the main things that has really changed just in the last couple of years since my last presentation. And it's not just the miners or the refiners or the recyclers that are kind of rethinking their approach given some of the backdrop. There's been a lot of, I guess, ink spilled in newspapers about an EV slowdown, which I would suggest to you, I think, is slightly misplaced, but based on some data that I'll show you here in a second. But nevertheless, whether or not your battery manufacturer like Panasonic or automotive manufacturers like General Motors, this is just a chart from Bloomberg New Energy Finance talking about original target dates for either joint ventures for battery production or EV production that either are delayed or in some instances canceled. Again, part of this has to do with the new kind of financing environment. Part of it has to do with overall demand. But I think probably the biggest issue why targets are being pushed out is simply because supply chains, battery supply chains outside of China, outside of Asia, just aren't built yet. Okay, they're not really scaled to the point where they need to be in order to hit some of these very aggressive EV goals. They will be, I think, and a lot of that has to do with the Inflation Reduction Act, which we'll talk about momentarily. But nevertheless, everybody along the supply chain is now trying to rethink goals and how to get from A to B to hit EV goals or whatever your stated goal may be. And so, as I mentioned earlier, there's a lot of talk of an EV slowdown. I personally haven't seen it. What you're looking at here is again data from Bloomberg New Energy Finance. But in 2023, on a global basis, if there was a battery, or excuse me, if there was a vehicle out there and it had a battery in it, so that could be pure electric vehicles or hybrids, about 14.1 million light-duty electric vehicles were sold last year globally, with China obviously being the bulk of that. And so, again, what this graph suggests is that even in the face of higher rates, even in the face of lithium and cobalt and nickel price volatility, and perhaps potential shortages for those materials, we're still looking at a situation where by the end of this year, at least Bloomberg is forecasting 17.5 million EVs sold on a global basis. So basically all of the capacity of 2023 plus another 3.5 million electric vehicles. And so again, this is in the face of an upstream portion of the supply chain, which is currently retrenching and struggling with some challenging economics. So something has to give, right? And I think ultimately what is going to give is you're going to have to see higher metals prices in order to hit these EV goals, whether or not it's 17.5 million or 22.4 million in 2025 from a unit perspective. So I think that, again, it's what we're witnessing right now, again, despite some of the challenging backdrop, is really more of a blip than anything else. From a geopolitical perspective, and this is kind of the second point that I wanted to make in terms of thinking about different risks, despite the Inflation Reduction Act, despite what's going on in Europe to try and incentivize the build out of EV supply chains and EV sales, China, because they started this whole process about 15 plus years ago, is going to maintain their lead and going to maintain their dominance, right? What you're looking at here, again, more data from Bloomberg, but on the left-hand side is kind of last year's percentage breakdown in terms of where most battery materials are made, whether or not it's cathode, anode, electrolyte, separator, or cell. And you can see the maroon sort of bar there is China. North America does not really factor into the equation, at least not yet. And of course, by 2030, if you look on the right-hand side of the screen, China still is going to remain dominant. I don't think that was ever in doubt or in question, but at least there's a little bit of pink over there. So that is where domestic sources or regional sources of these raw materials are going to become very, very important if we want to start to cut into China's lead on the battery component perspective. And it's not just the battery components, kind of the midstream where China is dominant, although it is a much more nuanced picture if you look at how China interacts on the upstream portion of the supply chain. The interesting thing is China is not really a major copper miner or lithium miner or cobalt miner. I don't think there's any domestic cobalt mining in China. If there is, it's not particularly consequential. As you can see, graphite and rare earth elements are different stories, but again, one of the other areas where China today really does dominate the supply chain for not just producing metals, but producing high purity, high quality materials is in the refining. Okay. And here in the United States, there are 3 lithium refineries, just to use that as an example, that are either announced or under construction. The first and probably the most advanced is Tesla's in Corpus Christi, Texas. They have talked about getting into production sometime this year. I'm a little doubtful of them being able to do that simply because I'm not sure if they have enough raw material wrapped up. So going to be an interesting few years as we here in the United States try to again, loosen China's grip or hold on the supply chain. And so pricing geopolitical risk, one of the questions that always comes up in these discussions, in these talks that I have is the Trump factor. Okay. I do think the IRA, and we'll talk about it here in more detail in a second, is an enormously beneficial and consequential piece of legislation. Donald Trump has made it very clear that he does not like it. And so there is the possibility or maybe the threat of a Donald Trump presidency. Maybe the threat to the IRA is a more diplomatic way to say that. But a Donald Trump presidency coupled with, a majority either in the House and or the Senate would certainly spell trouble for the IRA. It's a little too early to know exactly what that looks like. But again, the IRA goes way beyond just batteries and supply chains, right? It's a big part of it, but this is a 730-page document that really does touch a lot of different parts of the United States economy. So the challenge you have, I think, in geopolitics is not just domestic. How do you source raw materials when countries like Chile or Indonesia or even allies like Australia or the European Union are all crafting their own supply chain strategies with the goal of sort of close or resourcing or nearshoring their own supply chains? What does that mean? What is the read through there for raw material availability? Again, I would argue that you're going to see higher rather than lower raw material prices going forward as more and more countries get more aggressive in terms of cementing their own strategies around these raw materials, critical raw materials. Just a few ideas on some geopolitical flashpoints. Again, I think these issues probably should inform your view in terms of how quickly or maybe how difficult it will be to build supply chains on a regional basis. Some interesting data out there, according to Voice of America, based here in DC, I believe. 4 billion people, I did not realize this, but roughly half of the global population will vote in elections this year. Okay, obviously, to many of us on the call, the most consequential election will be here in November in the United States, but there will be parliamentary elections in the European Union, elections in India, elections in Taiwan, which actually already took place. And so, again, you just want to think about what the implications for industrial policy are on either a country by country basis or a regional basis, depending upon who wins and who loses. Second geopolitical flashpoint, I think, is China. Look, I mean, we all on the call, I think, are aware of how important China is to commodity demand. And if China is set to grow at 3 or 4 or 5% per year, as opposed to 10%, which you could argue that it had grown at for a number of years previous to what's going on there currently. A slower China, despite the fact that the economy is much larger, what again does that mean for commodity demand? I mean, with China at 50% of global copper consumption growing at half of its speed, with so much of that economy really tied into the real estate and the construction market, what does that mean, right, for nickel? What does that mean for copper? What does it mean for lithium? Again, I think selectively, certain commodities are poised, I should say, to do quite well, irrespective of kind of the trajectory of China's economy. But my point is, I wanted to lay it out there as kind of a geopolitical flashpoint in 2024 and beyond. On a more positive note, as I mentioned before, the Inflation Reduction Act, which I'll address directly in the next slide, the domestic effects of industrial policy are going to start to be felt. Again, the Inflation Reduction Act really is around a $300 or $400 billion push into electrification and in towards the energy transition on a domestic basis, excuse me. In addition to that, the Department of Energy, through its loan program office, has tens of billions of dollars of loan capacity. And I believe it was just yesterday that it was announced, if I'm not mistaken. But some of you on the call may be familiar with Lithium Americas, publicly traded company. They are in the process of developing the Thacker Pass lithium project out north of Winnemucca in Nevada. That project, for phase one of their capex, will receive, or is slated to receive, a $2.2 billion DOE loan, and the rate on that will be roughly that 10-year government bond that I referenced earlier. So not as low as it was, but 10-year government debt. The yield is obviously much lower than having to go into the corporate market and borrow. So really, really positive. And I think this is probably the first of a number of announcements, whether or not it's with respect to critical materials or semiconductors, that you're likely to see. So this industrial policy push, I think, is going to make itself very evident, especially since we're in an election year here in the US. And then finally, you know, sort of have this inflationary overhang, I would argue, in certain parts of the global economy: Ukraine, Israel, Gaza, the threat of an invasion in Taiwan, I should say, by China, which I think is a pretty low probability, but nevertheless, these are just some risks of war and conflict, which is inflationary, right? Which can keep a light of fire under certain commodities. So just some things I think you want to think about from a geopolitical perspective as you try and inform your investment view and your investment thesis going forward. Couple of notes here on the IRA, okay? Because this is a document that, while it is a law, is open to interpretation and is continuing to be interpreted by both the Department of the Treasury here in DC, as well as the IRS. And so, look, as investors, or folks perhaps running companies out there, there are really 4 subsections of the IRA that you want to pay attention to, because they will directly affect your bottom line positively: 30D, 25E, 45W, and 45X. 45X in particular, really, in my view, if you are a battery component producer, or if you are a battery manufacturer and you're producing cells and packs, 45X makes it enormously economically beneficial to produce battery materials here in the United States. Not in Europe, not in anywhere else. I'm not sure what the economics really look like relative to China, but certainly competitive with China, and much more competitive than the EU. And so the key, though, when you're thinking about where you're sourcing your materials from, you can see I have it highlighted and underlined and in quotations here. The material has to be extracted, processed, or recycled in the US or by a free trade partner, okay? The United States has over 20 free trade agreements in place with other countries. I think 22, if I'm not mistaken. 6 of those countries have anything to do with the battery metal supply chain. So it's Canada, Mexico, Australia, Chile, South Korea, and Morocco. Those are the big 6, right? And so those material coming from those 6 countries, again, would help you qualify for some or all of these tax credits, depending upon how you're positioned. So again, just something to think about. But of course, one of the interesting things that was happening is that, Chinese players realized, wow, China's what's known as a foreign entity of concern. In other words, if material is coming from China, whether or not it's mined or refined or battery components, and that material is imported into the United States, it would not be eligible for a certain portion of the tax credits. In particular, the tax credit for EV purchases under 30D, which equate to a total of around $7,500 US. And so what Chinese companies were doing is going and setting up shop in free trade partner countries like South Korea and like Morocco, and then kind of loopholing it to be able to claim some of those credits. And so what has happened is you have some new guidance now around the Inflation Reduction Act, okay, where the Biden administration realized that the Chinese were setting up joint ventures with some of our free trade partners to access these tax credits. And so the Department of the Treasury, the Biden administration, kind of brought the hammer down a little bit on more clearly defining what a foreign entity of concern is. So starting in January of 2024, a couple of months ago, companies that are owned by, controlled by, subject to the jurisdiction or direction of a government of a foreign country that is a covered nation, and that would be China, Russia, Iran, or North Korea, are regarded as foreign entities of concern, right? And would not out of the gate be eligible for any or all of the tax credits, or a company that used their material would not be eligible for any of these tax credits. And so what happened was the pendulum swung very hard one way and said, okay, no more China, period, end of story. And then I think the Biden administration and the EV industry realized, wow, we cannot function, right? We cannot leverage an EV supply chain without Chinese help, without Chinese technology. And so the rules are still in the process of being updated, but as it stands today, if a foreign entity of concern has a 25% interest in a company, and it could be board seats, it could be voting rights, it could be an equity interest. If the foreign entity of concern owns, say, 26% of any of those metrics that I just went through, that material would not be eligible for the tax credits. And so what you're starting to see now is the idea that the Biden administration and the Department of the Treasury is coming back and saying, okay, well, China can play a role for now, but they cannot be a majority partner in any joint venture. And also technology licensing agreements are permitted as long as the non-FEOC partner has operational control of a facility. Just one example of what that looks like. So Ford and CATL here in the US in Michigan are building a plant together. It's very controversial. I think the only thing that people here in DC that can agree on is that China's the bad guy. So for better or for worse, Ford will be utilizing CATL's lithium iron phosphate technology to build battery packs at a plant in Michigan. And so as long as there's a technology licensing agreement, and as long as Ford owns the plant, operates the plant, and hires and pays the workers, it would be okay. And so it's a little bit of a test case to sort of see how this all shakes out. So just finishing up, again, thank you all for your time and attention on a Friday afternoon here. Just some takeaways. Look, to reiterate, it's an incredibly exciting time, I think, to be involved in this space. I would have been a little less certain about that maybe 2 years ago when I gave my original presentation to the MMSA, but there are some things you need to realize and watch out for, things that have changed. Again, battery metals price volatility, the cyclical nature of the battery metals is a feature and it's not a bug. And you need to think about hedging strategies. You need to think about ways to sort of, play that, given the fact that we are likely to see 40 or 50 or $60,000 lithium at some point in the future, just as we have in the past. Higher interest rates, I would argue, are here to stay for the foreseeable future. Again, so that has implications in terms of project costs and also economics overall. Decarbonization, I think one of the things we've really learned in the last couple of years is that it's very capital intensive. Leveraging technology is very important, I think, going forward. That helps you sort of manage your costs. And so that is down at the bottom, as you can see. A couple of areas of interest where I think are underappreciated by the market are companies that can either find ways to leverage technology to lower costs overall, could be for different methods of lithium extraction or something like that, or different cathode production technologies or recycling technologies. And also just from a geopolitical perspective, I think that, we will not have 30, 40, 50% EV penetration rate on a global basis without much more raw material participation from Africa, from the continent of Africa. So you are likely to see, and the Chinese are already there. And so I think that one of the interesting things the Biden administration could do is pay a lot more attention to that part of the world from a raw material and a supply chain perspective, because I think it's going to become very, very important. And so with that, I will pause. Again, thanks very much to Betty and Curtis and everybody else at the MMSA for the opportunity. Happy to take any and all questions. And again, thank you all for your attention.
Thanks, Chris. That was really, really interesting. I really like your perspective. We really have one question, and one of our participants sort of answered it. So I'll read those, and then you can give your comment.
Sure.
The, the question is, why is China so dominant in refining And James Sorensen says, I believe it's partly due to its vast size, which in turn yields large land and mineral resources. Another factor is they've been ahead of the game, have much cheaper labor and less environmental regulations.
Yep,
Your comment?
that is correct. I mean, the lax environmental regulations certainly allowed the Chinese to dominate the rare earth element space. In particular, rare earth elements are 15, 16, 17 elements typically found together in the Earth's crust, absolutely essential for certain technologies. One of the challenges, though, is when you mine and refine rare earths, it is very often found with uranium and thorium, radioactive elements, which need to be disposed of. And that has always, or handled or managed a certain way. And that has never historically, I think, been an issue in China the way it has over here. But, one of the other issues with respect to refining is that, again, the Chinese, I think, have the intellectual firepower, right? They graduate hundreds of thousands of engineers every single year. Number one. And number two, they have a huge cost advantage with respect to labor and reagents. And again, access to land. I mean, a lot of what goes on in China is subsidized by the state. At least it has been historically in terms of building out that capacity. And so refining really is the critical piece, in my view, in this whole supply chain. A company, for example, like Ganfeng Lithium is really, in my view, one of the, if not the market leader in terms of lithium geochemistry, right? Geochemistry with respect to brines. And so they have been helping, for example, companies like SQM with brine refining literally for decades. And so again, I wish there were, a three-ring binder where you could sort of pull something off the shelf and say, this is how you refine nickel or lithium. But the Chinese, because of some of the factors that the individual mentioned earlier, coupled with just lower labor costs and more labor and just a 15, 20-year head start, have really, really dominated that piece of the supply chain. And again, are likely to continue to dominate it going forward because it's not, building refining capacity is not a static thing. Even though I would argue there is excess refining capacity for certain metals in China today, there's nothing precluding them from continuing to pad that lead.
Okay, the next question is from Garrett Bell. Is manganese affected similarly to the other main battery metals I have identified?
Yeah, I would say I didn't have it on my original chart. I think that manganese is going to become a lot more important in the future in batteries and battery chemistry. I would argue today that manganese is more of a steel story than anything else. I mean, the majority of some of the manganese work that I've done, I just think that it's more of a kind of an infrastructure play more than anything else. But that said, when you think about different battery chemistries, you have, I mean, the two big ones that are in the automotive business are NMC for nickel, manganese, cobalt, and LFP for lithium iron phosphate. They have their pros and cons. Again, we could go down a rabbit hole of which is better for which end use. But nevertheless, what you're starting to see is manganese being utilized in LFP technology, lithium iron phosphate technology. And that is a direct play on increased energy density while keeping your costs down, keeping your cycle life up, and also managing the safety of the battery overall. So I would argue that, I think I don't have any of the numbers in front of me, but manganese certainly important. But likely to see growth more in line with kind of global industrial production and steel demand more than anything else. Perhaps maybe a little bit later this decade, you could see some sort of a pinch with respect to its use in batteries. Again, one of the challenges with manganese is that a lot of the refining capacity, like electrolytic manganese in particular, exists in China, right? And so the question is, well, who is going to take the risk, the financial risk, the permitting risk to build a manganese refinery outside of the country, given the cost advantage that the Chinese have? And it's just an open question.
All right. The next question is from Liz Lappin. Curious about price volatility related to flooding the market with supply and any ability for countries and or companies to protect against that, such as stockpiling and offtake terms.
Yeah, I think that's a great question. It's very pertinent depending upon the raw material that you're looking at. As I mentioned before, earlier, a couple of years ago, end of 2020, 3.5 years ago, lithium was at $6,500 a ton, went to 85, fell to 21, jumped to 44, and now it's at, I don't know, 15 or $16,000 a ton. Some of that is just an opaque, tiny market with traders in China kind of playing around with the price. I think one of the challenges when you think about how to price these raw materials is that, in the case of lithium, I would argue there is no single lithium price. Okay. You have a China price in the spot market. You have contract prices, which are typically higher. There's a lot of work being done by price providers like Benchmark Mineral Intelligence or Fast Markets or Platts to try and provide some transparency there. And some of the other interesting things that are happening, again, I know this is very lithium focused and I apologize, but lithium producers like Pilbara Minerals in Australia and Albemarle, based here in the United States, are going to start auctioning small lots of spodumene in the interest of price transparency. So just giving folks an idea, players along the supply chain, just because, the China spot market says that, spodumene is $1,000 a ton, that doesn't necessarily mean that that's what the true price is. How you prevent flooding the market, or how you protect yourself. Again, I think that's sort of an individual strategy depending upon where you are on the supply chain. I mean, the lithium futures market is very small, very opaque. A lot of people are starting to look at, again, lithium futures pricing in China, which I don't think would really help with price transparency personally. A lot of people focus on it a little bit too much, in my opinion. There is a lithium futures market that is being developed ex-China, but again, not a lot of liquidity. So, your your hedging, I think, strategy, first of all, you've just got to find those world-class assets, right? And those world-class assets have scale and particularly very, very high grade. And as a consequence of that, low cost. Some of the lithium assets that I can think of are actually, especially the brines in Argentina and Chile, are still very economic, right? Even at current market prices and current, I guess, views, if you will, on oversupply. I personally don't think we're in oversupply on the lithium side. I think that what you're likely to see is we've got about 1 million, 1.2 million in demand in terms of tonnage in 2023. And with current pricing where it is today, I would argue about 200,000 tons of the supply chain, or of the cost curve, excuse me, is either not economic or marginally economic. So you're actually, I would argue, likely to see a retrenching in the market as we're seeing now, and prices tick up towards the end of this year. So you're coming back to your original question about, well, how do you protect yourself against oversupply? Look, that's a supply chain management issue, and I think a lot of it, unfortunately, really revolves around the asset in question. If you have a high cost asset, you're in trouble. But not necessarily the case if you're dealing with some of the lithium assets, for example, in Chile or Argentina, or nickel assets in Argentina or in Indonesia, pardon me.
Yeah, there's a follow-up question from Alistair. Is price volatility not a disincentive to long-term investment in battery metals, infrastructure, et cetera?
Yes. Yes, it is. And that's one of the problems. You have governments, pushing forward with decarbonization strategies, outlining, internal combustion engines. I know a lot of those bans are not binding, but nevertheless, you have governments saying we have to decarbonize, we have to do this, we have to manage emissions. Meanwhile, the financial markets look at these tiny, lithium at 1 million tons a year, cobalt's tiny, rare earth elements are tiny. Um, and acting sort of accordingly, right? I mean, the price volatility scares a lot of people away. I mean, I have been focused on the lithium-ion battery supply chain dynamics for 14 years, and this is the third cycle I think I have lived through, both boom and bust. And each time, pricing went sky high, everyone got excited, and then it came back down to earth, and it scared a lot of potential longer term investors away. I think that the government signal with respect to what's going on in Europe, and the Inflation Reduction Act provide a little bit of comfort to longer term investors. But yes, pricing sort of swinging hundreds of percent on a year-over-year basis is very, very challenging. And so again, that's why I think it's important to find high quality assets, number one. But number two, structure your deals, structure your offtake agreements with maybe ceilings and floors. So if you are buying lithium, for example, you're not paying $80,000 a ton, or you're not selling it for $6,000 a ton if you're a miner and losing it. So there's a lot that I think kind of ties back to the original question about how you hedge. A lot of that has to do with offtake agreement dynamics as well.
Anthony Staley has a comment. You noted that a weak point of the IRA was that it did not address mine permitting. I would
Yeah.
add another weakness as it pertains to recycling. It does not address regulation reform for the lithium battery management and in the intermediate recycling product, black mass. And I would add a little addendum to that. In April, we are having a webinar about battery recycling. So I'll be
Hmm.
sending out that notice to everybody as well. So go ahead, Chris, comment
Yeah.
on the comment.
I agree. I think that black mass, for those of you not aware on the call, black mass is effectively whether or not I take battery scrap or an end of life pack, I feed it into a shredder, and one of the products that is spit out is black mass. That's the cathode and the anode kind of ground up, which is then can be either put through pyrometallurgical or hydrometallurgical processes to extract the valuable metals. Black mass is, again, a small market with very opaque pricing dynamics. How you legislate black mass, for example, in the European Union, black mass, to my knowledge, is a hazardous material. And so it has to be handled and treated and transported a certain way. That is not the case, to my knowledge, here in the United States. It may vary from state to state how you view things like black mass, but the transport, since it's not viewed, in my view, or in my recollection, as a hazardous material, it's much easier to transport, right, and get from A to B. But again, your strategy, I think, around recycling has to be one of, do we co-locate shredders and hydromet facilities next to gigafactories, or do we have more of like a hub and spoke model, like that company Lifecycle does that I mentioned before? The IRA with respect to recycling says that the material has to be recycled or processed in North America, right? So that's basically Canada or the US. So, it's a little bit challenging there. Again, that one of the other challenges with the IRA, yes, it doesn't address permitting or permitting reform, but it is still a little bit of a work in progress. Partially, again, as I mentioned before, because China is so dominant along the supply chain. We're just sort of trying to figure out, how do we here in the United States and in North America kind of reshore, rebuild, however you want to phrase it, right? De-risk supply chains when we really can't do it overnight, because of course it takes years to build these projects, and again, China is so dominant. So I think we can probably take some lessons from China with respect to how they built their lithium ion battery recycling process ecosystem, because they are about 10 years ahead. If you sort of look at the lithium ion battery recycling ecosystem in China, got a few national champions. There's logistics, there's world-class technology on the hydro side. And so that will be in Europe in short order. I don't think you'll see it here, again, because of IRA dynamics. But nevertheless, there are models that I think we can utilize here in the United States, even from adversaries like China, to try and get the build out correct here.
All right, I think that's all that I see in the comments and the questions. So very many, many thanks to you, Chris, for your presentation. I thought it was really interesting. And for
Great.
all of you who participated, thank you so much for attending this webinar. We do have several webinars coming up, as I mentioned, during the next three months, and I will be sending out notices for these webinars. Two of the webinars coming up are on battery metals. As I mentioned, one of them will be on recycling, and another one will be from an aluminum expert. We have been scheduling our webinars on the third Friday of the month, so we'll continue to do that. Our speakers seem to be okay with all that. And we will be uploading this webinar as well as all the others onto YouTube, and they can be accessed through the MMSA.net website. And the video of this webinar will be on the website within about a week, maybe sooner if I get to it. The MMSA webinars are supported by the Jackling Foundation, and we will send you a notice when the video and slides are posted on the MMSA website. And thank you, everybody, for coming. And thank you again, Chris, for the great presentation. I thought it was fascinating.
Great, thank you. We'll do it again in a couple of years, right? That's the
Yeah,
cycle.
right. We'll need another update, depending on who's the next president, right?
Oh my gosh, yeah. It'll be very different regardless. So anyways,
Either
thank you all for
way.
your time and attention. Yeah, I appreciate it.
Thanks, Chris.
Okay.
Thank
Thank
you.
you.
You bet.
Webinar is
Bye-bye.
ended. Bye.